James, thank you so much for your time.
Joe Poulos, good to see you.
It's great, as always, to see you. We've had a chat a number of times about interest rates. For those people who haven't listened to our podcast before, your Mortgage Choice's biggest franchise owner. You've got the most number of Mortgage Choice franchises, and also you write the most number of loans out of any Mortgage Choice owner in Australia. So I figure you have your finger on the pulse in what's happening with interest rates.
We do. And the big thing we have, Joe, is that the coverage of the different markets. So from Sydney to the Sunshine Coast, we've got 7 different retail locations in very, very different regional areas. So, Sydney, then Central Coast, they're very different clients. So Surrey Hills is where we are, which is your old stomping ground. And then all the way through Gold Coast, then Brisbane as a capital city of Queensland, but also the Sunshine Coast. So you've got some really wide-ranging clients, client groups, employee groups, and everything else.
Yeah, so you've got a good handle on what's happening in each market, which is good. Yeah,
and there's differences, Joe, also in the leads and the inquiries at different times. So you'll find Sydney will go to sleep later into January, whereas the Gold Coast comes out of the stops really fast. So you wouldn't think there are those differences, but there are actually differences between the capital city and the regional city.
2025 was a big year for interest rates. We had 3 separate cuts, February, May and August.
Yes.
We're now at 3.6% for our cash rate, and lots of talk about an interest rate increase in 2026. So what I'd love to do today is catch up with you and talk about whether or not you think that interest rate prediction is going to come to fruition in 2026. And if it does, when is it going to hit?
I think it is a little bit blown out, and I think the market is overreacting to the inflationary pressures. Let's think back and let's go, what were all the state governments doing to the electricity bills? They were subsidising, right? And they all came off at the same time. What that means is there was a flash in inflation. So that, coupled with increases in other costs, meant inflation was outside of that band. Now, end of January, we'll know the true figures of this last quarter of the year, all right? And I don't think you're going to find it as bad as we're thinking. I actually think when you start listening to some of the job losses in different states, certainly there were some in Victoria and even Queensland, I think they would be pretty foolhardy to putting them up straight away. So my pick is we possibly won't get another rise. We won't get a rise. I actually think there's probably another drop in it. But that's a big call, right? That's a big call. And that's from me looking and feeling across this market. Yes, lending's going, but it's driven again by first-time buyers, by the government guarantee scheme. So you'll find, I feel, that the inflation will come back into band.
Certainly, I think, retail spending over the Christmas period has always been a key indication of inflationary figures for that first part of the year. So it'll be interesting to see what happens with Christmas spending, and then, as you say, with employment numbers, which will all reflect on those or will translate into that inflationary number.
And even the Black Friday stuff, right? That kind of pulls forward some of that Christmas spending. And then you find that the monthly CPI is very fluctuating. It fluctuates quite rapidly, really. So when you think about that as well, and you throw in a Black Friday into it, potentially that could flame that monthly CPI figure as well.
Yeah, certainly from a buyer perspective, we're still seeing a lot of first home buyers and investors looking at that sub 1 million category. That's still a red hot category. And also in the early ones as well, because, investors are still getting really great yields at that price point. What are you seeing in terms of lending? What is the most active customer segment? Is it first home buyers? Is it refinances? Or is it people? Is it owner-occ?
Different markets, different places. Okay, so in the Central Coast, we found that they're buying a lot of secondary homes. So there's a lot of bridging happening, a lot of guarantor stuff happening as well, sometimes for their first homes. But they're buying an owner-occupied. In Sydney, we found there's a fair increase in investor. And on the Gold Coast, we found there's a lot of people increasing their home loans, whether it be for improving their home, decided that they don't want to move. There's also been a bit of a flare-up of bridging. So that's when people have found their house and haven't sold yet. Interesting thing is pre-approvals. We used to say out of 10 pre-approvals, 3 are going to find a home. At the moment, I think 4 or 5 are finding a home,
Right.
which is a big increase, is a good increase, because for us as a business, a pre-approval is a non-starter. Until somebody finds a home, it's just work.
And that's what we've seen, in the last 12 months in particular, this short supply of stock, and buyers are, they're getting the pre-approval, but then they can't find a home.
Yes.
They can't secure a home. So are you seeing any reduction in that number of days or weeks or months that it's taking people to find a home once they get pre-approved?
If people are committed buyers, they're finding the home, but some people are being more picky because there's a little bit more choice in certain cities. So there's a bit more stock has come on in Sydney, and you're finding people are being a little bit more picky about what they're buying. So with the help of being guided by, say, somebody like you, Joe, generally they're more committed buyers and they're going to be able to find what they need.
Yeah. I think also, what we're seeing from the buyer side is, properties that are good quality properties, well priced, are moving really quickly. But any property that is overpriced, is sitting, because buyers are very, very afraid of overpaying for a property. So even if a property is, incorrectly priced or overpriced by, 5%, they just won't look at it. They won't even negotiate on it, and properties are sitting. So getting a property priced incorrectly is scaring buyers off.
Yeah, that's an interesting. We're finding valuations are still getting on the money. So we're finding that people haven't overpaid. So that probably rings true to what you're seeing, that you're finding people are not been able to do that.
Yeah. People, I think, are very reticent to commit to a property or even negotiate on a property if there's the slightest hint of it being overpriced. So, what we're seeing in market is realistic pricing, and properties that are correctly priced are moving quickly, but those who aren't, they're sitting.
Where are the stock levels in your view at the moment? Are they higher or lower?
There is more. Well, we're coming into December now, so there's a lot of listings that are being held back until next year. So, there's a window at the end of the year where people are trying to get deals done. Vendors are being more negotiable on price because they want to secure a contract before Christmas.
I want to start the new year with this is what we're doing, yeah?
Yeah.
Realistically, that makes the difference, doesn't it?
Yes. But what I'm seeing, just in the last, couple of weeks, people are holding their listings over till next year. So, we do have line of sight of what is going to hit the market sort of mid to end of January, but there's, there'll be not a lot on the market over the Christmas period.
There's been a couple of poignant changes you probably need to be aware of in lending, company and trust lending. So where you're buying as a company and a trust, a big lender like Macquarie are no longer doing it. And they're blaming a lot of the spruikers on TikTok and on Instagram and things like that for basically saying this is because you can get around different lending rules by doing it that way. And the interesting thing is Macquarie may have stepped back from that, but there are other lenders that are still doing without an issue. But it's worth noting because one of your clients could potentially go, they're my bank, I've used them forever, and they want to go and do that. And suddenly they can't borrow. They can't borrow at all just because they own a company as a trustee for a trust. And at the end of the day, it's a tax effective strategy as advised by their tax advisors. So that's something that's worth just knowing is you need to know about that.
And does that revision impact SMSF investors?
No, it doesn't. Specifically for SMSF, they're already out of that space anyway, but it's purely for pure investors looking with investment properties.
Okay. And speaking of investors, are you seeing an increase in investor activity?
We certainly are. And I would again say that's probably a lot in the Sydney market as well. And you're finding some in the Brisbane market too. You're getting a lot of people, some first-time buyers are going, I can either keep renting, right, and get a nice spot where I want to live, or I can go and buy my owner-occupied home and it's not going to be where I want to be, or I can buy an investment home in a really choice area and keep renting in the place I want to be, and they're doing that. So they're calling it rent vesting. Right?
Yes, certainly an increase in rent vestors. And I think, the increase in investor activity, particularly Gold Coast, Brisbane, which is the markets that we are most active in, securing properties for clients, they're driven by really strong capital growth forecasts, as well as low occupancy that's driving the yields. So
Rents, you still can't rent a property on the Gold Coast. So it works with the investing.
making property investment very attractive for investors who are coming back into the market. And as supply comes back in next year, I think there'll be more investors that will jump back into the market again.
A couple of clients have talked about unusual setups, so where they're doing multi-purpose properties. So, for example, they're renting it to 7 people and they'll have little mini kitchens. We're finding a few of those, and there's a couple of lenders that are doing those. So they're trying to obviously fix the housing crisis. So they have a higher yield, but it's obviously a much bigger wear and tear. It's a tougher thing, but we're finding a few of those on the Gold Coast and certainly in Brisbane as well.
Yeah, I think those sorts of properties have become more and more common. And there's also, there's more developers that are specializing in that sort of product as well. Higher yield, lower capital growth, obviously, because, smaller buyer pool when you go to sell that.
Potentially your neighbours might not love you too much as well.
Yes. But multi-use as well, student accommodation, NDIS, that product is very appealing to a broad range of renters, but the buyer pool is smaller. But some investors are focused on yield, and that's all they're interested in. And those sorts of investments are going to work really well for them. So, last question I have for you: what's the lender who's doing the best rates at the moment?
At the moment, off the desk, we had what they call a under the table pricing offering.
Mm-hmm.
So GSB, which is Great Southern Bank, which is actually CUA, Credit Union Australia, they are offering a 519 on a variable. So you could have offset with that as well. So that's that's extremely low rate. So what you would find is low fives. We've also found some different Unity banks are now offering investor rate in the low fives as well. So that's breathtaking. To offer low fives in investor rate, that's next level.
And if we get another rate cut, we'll be under the 5.
We'll be under the 5.
So with so much speculations on a rate increase, what would your advice be to people who are contemplating fixing?
You've got to look at your individual circumstance, right?
Yeah.
It's got to be looking at your individual circumstance and risk. But the moment I'd sit on my hands. If it was myself, I would be sitting on my hands to wait and see what these figures are saying, because the fixed rates have already run.
Right.
If you were going to fix, you would have done it a couple of months ago.
Right. So have banks already priced in fixed rates on an increase, do you think?
The money markets have already priced a rate change, but the money markets got well overexcited with those inflationary figures.
Right. So don't fix.
Don't fix at the moment.
Okay. Hold.
Holding pattern. Let's see what the data says. It's going to be very, very strong. If in January it's blowing up, then you've got to be making some decisions. Do you split your loan down, fix some, have some variable? Do you split it into 3 ways? Like when we're in a rate rising market, we had clients that would split it 3 ways. They'd do a 2-year, a 5-year, and a variable. They split their risk that way. But the big thing is the banks very, very rarely lose. So on a fixed rate, Joe, if you fix and the bank's losing, guess how much it costs you to get out? Nothing. But they don't give you any money, right? If you have a fixed rate and basically you're going to lose, you have to pay the bank.
Yes.
So the banks don't like losing.
House always wins.
Yeah, house always wins.
James, great to see you. In summary, we may get a rate cut early next year, depending on inflationary numbers.
May not be early. You might find February decision may be a sit on the hands to wait for more data. But I think you'll have a good feeling at the end of January when the CPI figures come out for December, which way it's going to go. Because if it stays elevated, then potentially it's not going to come back.
And the big things to look out for: employment figures,
yes,
and retail spending.
Yeah.
Okay.
And also that consumer price index. Yeah, so let's keep an eye across that. But the monthly stuff can be very inflated. It's the quarterly they look at.
Right.
Yeah.
Okay, well, we'll see what happens early next year, and we'll circle back with you again next year and see how we're traveling with rates.
So we'll go. We did this last year, I think. What we're going to do is we're going to say a rate cut before the middle of next year.
Right. Okay. Well, watch this space.
Fingers crossed.
James Hasselle from Mortgage Choice, thank you very much again for your time.
Thank you, Joe.
Thank you.
Lovely. Cheers.